the people who are forecasting a crash, are basing that off of an increase in inventory, and that's not happening. And so I think there's a lot of reasons to believe that we are in a correction. Things are going to moderate, but they are not going to bottom out like they did in 2008. And personally, I honestly think it's probably a good thing.
Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach, and this is a show all about helping you build a thriving rental property business so you can get out of the financial grind and do more of what matters. Whether you're a first-time listener or a long-time listener, thank you for being back for another episode. The title of today's episode is The Real Estate Market in 2023, What Investors Need to Know. This is an interview with Dave Meyer. He's the Vice President of Analytics at BiggerPockets, and he's in charge for them of understanding and studying the trends and the data of the real estate market, both on a national level and on local markets. And today I'm going to talk to him to help us understand what's actually going on. Economics is a difficult subject. It's tricky. There's a lot of sensational headlines out there. There's a lot of fear. There's a lot of things going on. And really, overall, there's a lot of confusion about what you should do as a real estate investor. And so in this episode, I'm going to pick Dave's brain. I'm going to talk about a report he recently wrote that I'll have a link to in the show notes as well, that helps us understand as investors, what are the main tools? What are the metrics that we should be paying attention to? And how does that affect us as investors? How does it tell us whether we should be investing or should not be investing? How does it tell us whether we're going to make money over the long run? So all of those things that you want to do as a real estate investor definitely are affected by the market. And so I'm going to dive deep with Dave in today's episode for myself to understand it, but also to help you and to give you tools that you can use as a real estate investor. But before we get to the main interview, it's time for this week's Behind the Scenes segment where I share a short snippet of what's going on with me and my real estate investing or business behind the scenes. And I'm going to keep this one short and sweet. It's going to be relevant to today's topic. We're going to talk a lot about national statistics. We're going to talk about big picture trends and how to understand them. But I want to give you a tip, something I do behind the scenes that's very helpful on your local level. So as you try to figure out the most important thing for you as a real estate investor, that's going to be the market statistics for you and your region and your town. And where do you get those stats? Well, there's a couple places. One is a free resource. You can look at the online resources like Redfin and Zillow. I tend to look at those because they're very user-friendly, and particularly Redfin lately has been really nice to look at with graphs and free stats. And you can just search by your town, your zip code, your metro area, and get a lot of the stats we're going to be talking about today, like days on the market, months of inventory, how much inventory is on the market, all the way down to like kind of the micro level. So those are really cool free tools. But I also want to recommend, and probably even better tool for you is, and what I do is I will often talk to my real estate agent, who's an important team member for you as a real estate investor, and ask them for the local MLS statistics for you in your market over the last few months. And you could kind of keep getting updates from them. And this is something they have free access to. Usually the local multiple listing service puts out statistics for all of their agents in the area that they can share with their clients. And so it's very helpful stats are the ones I like to look at. And they'll tell you things like how long properties have been on the market in the local MLS. That's called days on the market. You can look at how many months of inventory there are. Some of the stats we're going to be talking about today and even more will be on these reports. There's a wealth of data. You can get them on Zillow and you can get them on Redfin, but the MLS data is still very rich and good information as well. You want as much information as you can get on the local level. That's really where you're going to get some insights. And so I want to encourage you to do that. That's something I check in with my agent periodically. And especially as I've been in Spain here, I don't have my pulse on exactly what's going on in my market. I'm just curious. So I'll just email or text my agent friends and say, hey, can you let me know what's going on? Do you have any reports on the local area you can send me? I'll read it over, just kind of to get my data, to understand what's going on. And I'll also ask their opinion on what they see, where they see things going, and the data behind those opinions. So that's my tip behind the scenes, something I do regularly and encourage you to do as well. So now let's get started with the interview with Dave Meyer. Hey, Dave, welcome to the podcast.
Chad, thank you for having me. It's great to be here.
Yeah, been looking forward to this, and congratulations on the publishing of your book last year, Real Estate by the Numbers. I've seen it's done very well, and I hope people will check that out. I'm a numbers nerd and love the analysis, and there couldn't be two better authors than you and Jay Scott to put that together. So I just wanted to start off with that.
Thank you. Appreciate that.
Yeah, no problem. And today, we're in early 2023, and I do a lot of episodes on the podcast about how to buy properties, how to finance them, a lot of this, the kind of the nuts and bolts, the details of real estate. But one of the most requested topics that I have from people listening to this is, hey, how do I do all of that in today's market? Things are changing. They're always changing. And I thought about you. You're the first person I thought about to talk about this. You're the VP of Analytics at BiggerPockets. And you wrote a report that I read, and I'm gonna put a link to this in the show notes so everybody can see it. It's called The State of Real Estate Investing 2023. And it's an awesome report. You guys did a wonderful job with the charts, with the data. So people check that out. But I would love this to jump into that, Dave, and talk about a few things that stood out to me and help our audience kind of understand how to use their real estate investing in 2023, what's changed, what hasn't changed, what's going to work, what's not working. And the first thing I thought would be great to unpack is, we're going to talk about the future in 2023, but I love how you analyzed where we've come from. And so in particular, I'm hoping you could kind of just give us some landscape. February 2020 to June 2022 was an interesting period in the real estate market. So can you just give us a high level of what happened there from a statistics and kind of from the real estate market standpoint?
Yeah, thank you. And I appreciate the very kind intro. So when you think about the housing market and what happens with prices in general, there are just a couple, let's call it like 8 or 10 different variables that really impact housing prices. And in normal markets, some of those variables are pushing upward on housing prices. Some of them are pushing down on housing prices. And usually it averages out to something like 2 to 4% appreciation per year. And when I talk about variables, I'm talking about stuff like inventory on the market, interest rates, inflation, demand, these pricing, affordability, these types of things. In a normal market, there is some balance between these two sides. I often think of it as like a tug of war or scales, right? And usually there's people pulling on both sides. But when you starting in February of 2020, I guess it was about April, when the Fed cut interest rates to near zero, literally, every variable I track moved to one side of that equation and was just pushing up housing prices. So it created a perfect storm, if you will, of appreciation, where everything, we have strong demographic demand, for example, which is something that's overlooked, but millennials are reaching their peak home buying age right now, which leads to a lot of increased demand. We had super high affordability, and I know that seems counterintuitive because housing prices went up, but because interest rates were so low, it actually led to really affordable housing for at least 2020 and some of 2021. We saw very low supply, which pushes up housing prices. We saw inflation, which pushes up housing prices. So we were in for almost 2 years, this perfect environment where prices went up. And I know a lot of people feel like it's a bubble, and it is probably coming down a bit. But during that time, there was actually good fundamental reasons why housing prices were going up so quickly.
At the end of that period, so I think everybody can remember what that feels like. You're in the pandemic, there's all of that going on, but then all of a sudden housing prices, people are bidding on housing, it's going up, so that everybody could feel that in the market. But looking back at it now, what were some of the statistics that jumped out off the page at you in terms of actual price growth, maybe some rent growth as well? Like, everybody knew it was kind of frantic, but like, what were those numbers, and how did that fit into that kind of historical context of what real estate markets normally do?
Yeah, it's wild. And during that time, it went up, I believe it's 41% over that time, which is wild. Usually it would literally take decades for housing prices to go up that much. And we saw that in the course of 24 to 30 months. In terms of rent, it was a little bit more muted in 2020 because there was so much uncertainty. Rent stayed pretty calm in 2020, but then in 2021, absolutely exploded. You see certain markets that hit close to that 41%, markets like Portland, Oregon, Boise, Austin. Austin went up, I think, at 50% at one point. It might have come back down since then. So in a historical context, this is really unprecedented. Normally, for the housing market, I think people really overestimate how much appreciation occurs in a given year when adjusted for inflation. Normally, it's just 1 or 2% above the pace of inflation. And now we're talking about 40%, like double digits in 2 years. So this is really an unprecedented event, at least in terms of data I have, which goes back to like the 1950s. I don't really know what happened like in the 1800s.
Right. Yeah. So people's feelings of being a little out of control and this is crazy, this is unusual, we're right in terms of the statistics and what it's looked like. And what's so interesting to me about real estate markets is you could be in this business for 50 years and there's very few periods that look exact. I mean, they never look the same, like you had I've studied history of real estate a lot just from, other people and reading books, and the 1970s kind of jumped off the page as something to really pay attention to. In the early 80s, where you just had really high inflation, you had real estate markets that had kind of ups and downs, but even that was very different, than there's some supply shocks, but what an interesting 2-year period. And what I love to help people understand and learn from you here is that I want to move into 2023 here in a minute, but I really like how you break it down into those variables that you talked about. You kind of touched on a few of them, but I thought it'd be helpful before we go and start looking in the future to give everybody some tools and some things to measure, because you're the measurement guy, the data guy. And as I read your report, it was the most helpful thing about it was it's accessible. Like, these are statistics that you can go look up. You can follow, obviously, on BiggerPockets is a great source just to go and check that out and follow your news feed and your podcast. But also, a lot of these things that are things that we should understand. It's like a vocabulary we should understand. So if you're okay with it, I was just going to go down the list of some of those variables and have you just explain what these are a little bit. And this will help us all understand when we turn our kind of spotlight on 2023, we can start paying attention to those. And the first one was supply. And I know there's this idea that there's been a supply shortage of real estate, which seems a little unusual. We have all these builders and people building houses, but could you talk a little bit about how the supply demand side of real estate, and particularly the supply, how that affects the long-term pricing of the market?
So there is basically there's a bunch of different studies that show that there is not enough housing units to meet demand in the United States. And these come from a variety of sources. The NAR, the National Association of Realtors, estimates it to be something around 7 million. We also have Freddie Mac, a big government entity, that's about 3.5 million. Moody's Analytics puts it at 1.5 million. So no one's really sure what the exact number is, but the general consensus is that because of it, during the 2008 crash, a lot of home builders went out of business, and it took a very long time, nearly a decade, for construction levels to return to where they were during normal times. Right before the 2008 crash, it was too high. So you don't want to get back to that point necessarily, but you want to get back to, let's say, where it was in 2002, 2003. It took, nearly a decade to get there. And although we are back at a good construction rate now, at least as of a few months ago, that time period of a decade of underbuilding does lead to fewer homes. And just like anything, any economic market, when there is a shortage of supply and there is a lot of demand, which we'll talk about in a minute, that pushes prices up. And this sort of analysis is really on a long-term macro scale. Certain markets are oversupplied. Certain markets are really undersupplied. What we're talking about here is on a national level. And it is also mostly referring to single family homes, because we can get into this. It's kind of wonky, but there is a lot of multifamily building going on right now. But single family homes, especially in the starter home category, are almost non-existent in terms of new construction now. And so that's where I think even though there is more construction, it's not well matched with what demand is for the market. And so I think that's a really big component, not just for 2023, but going forward the next 5 or 10 years. It'll be really interesting to see how this plays out, because right now there's just a shortage of the type of homes that young families, millennials who are sort of reaching this age where they're starting their own homes and starting families want. And so it's going to be interesting to see, are we building the right type of houses? And if not, what happens to the prices of, single family homes that are well suited for where the demand is right now?
Yeah, I love looking at supply. I feel like this is not you obviously talk about it a lot, but I don't think investors talk about it a lot enough as one of their core criteria. And I know in my own analysis, when I'm teaching people to analyze a market, I often look at on a micro level, I say, where are the locations in your city, your town, where supply is naturally limited? Like, for example, I live in a small college town, and there's a lake on one side, there's a university on the other side, and then you've got some forest land that's like a national preserve on the other side. So you basically have like three natural constraints to supply. And because of that, if you buy within those constraints, then it's very difficult to replicate and build competition for your houses and your apartments within that zone. And so that's on a micro level. It works by, if you pay attention to supply constraints on a micro level, it's a very good investment strategy, because those areas, for me, the properties I've owned in those areas have gone up significantly higher than other areas, given the fact that we had demand in our location. So I love that you can also do that on a regional level, and we're talking about it sort of on a national level. And I'm curious if you have any tips for people when they're analyzing specific markets. So, hey, I'm looking at the Chicago metro area, or I'm looking at Indianapolis metro area. What are some ways that people can go and figure out what the supply looks like in their own market, not just on the national level?
That's a great question. And I totally agree with you about those. It's really hard to quantify, but those geographic boundaries that are different, that sort of limit it. I mean, the perfect example to me is I grew up in a suburb of New York City. If you look at Manhattan, it's a tiny island. They just can't make more real estate. And so prices have gone sky high. You look at places like San Francisco, which is on a peninsula. You see those types of restrictions to growth, and prices go up because they're still highly desirable places to live. I don't really have a good macro level way of analyzing that. You kind of just have to know your city well. And that's sort of one of those things where I feel like is good for investors, because that's just a function of how hard you hustle, right? If you know your city and you want to get it to know it better than anyone else, you can find those pockets that are really desirable and there's not a lot of supply. If you really want to get into it, I mean, I do this because I'm a nerd, but if you really want to get into it, you can look at zoning maps for your city too, because places where there's high density zoning, they could build multifamily apartments and there's not really a constraint on new supply coming online. Whereas if you look in a place where it's single family zoning and there's no empty lots, it's not likely that there's going to be a lot of construction there. I've done this in Denver. I've done this in some towns I own short-term rentals in, but you kind of have to really get nerdy about it and dig into those maps, because they are not easy to read.
No, it's so funny you mentioned that. That's exactly what I've done in my own market as well. I remember I had a mentor, somebody I listened to early on told me, you should get a zoning map. You should print it out. They're all digital now, but go send it to the color printer locally somewhere, get it blown up on a big poster, and put it on your wall. And I would just stare at the map all the time, oh wow, okay, interesting. The dense red, the red zoning, or the very dense zoning in my area was red, and then there's other ones that are yellow. The single family zoning. You start to get kind of patterns in your location, and you figure out. For example, one of the things I figured out that really we made a lot of money on was that the RM4, the most dense multifamily zoning, was pretty rare in our town. We had lots of single family zoning. And there's one particular part of town that I was just talking about that was constrained by supply that also had just a little bit of multifamily zoning. And we marketed to properties in that location that were duplexes, fourplexes that were in multifamily zoning that eventually could be upzoned. You could build something more dense on them. So I don't know, that is kind of nerdy, but just the concept of looking at your zoning map is one of the most valuable ways, not only to figure out where supply constraint is, but also to understand that the zoning itself constrains supply. It's not a natural barrier of lakes or things like that, but it's actually a man-made constraint, right? I mean, you can't put, unless you get something rezoned, which is very, very difficult to do, you can't put a multifamily zoning in the middle of a single family neighborhood, right? So it's really good to know those things. I'm glad you brought that up.
Totally, yeah. And I think you made a good point. You can look at zoning maps to try and understand what's going to push up appreciation because no new supply will come online. We can also look at zoning maps to figure out where you can add new supply. I did this in Denver. I never wound up being successful at it, but I was really interested because I thought they were going to allow more detached ADUs, like the DADUs. And I was just like obsessively looking for this very specific type of lot that would allow me to start adding supply to these markets. It didn't out, but the whole state of Washington just allowed upzoning, and now you can do that. So in certain areas, so if you know about these zoning differences, it actually can give you a huge advantage as an investor.
Absolutely. Love it. Well, we've gone micro and then we've gone macro. So the supply is just something to pay attention to. So we'll come back to that in 2023 when we're looking at what the market's doing. I want to move to one other one that's very closely related. And it might be, as we're talking about the local level, a better indicator of supply demand kind of balance. And it's something you talk about is inventory of housing. So could you talk a little bit more about that and then how that plays into that kind of balancing you were talking about of upward price pressure, downward price pressure, and what inventory of housing has to do with that?
Yeah. So what Chad and I were just talking about is supply sort of on this macro, large, long-term scale. Inventory measures what's going on in the market right now. And that's really important, I think, in this type of market that is in a correction, and different markets are really starting to behave very differently. And inventory, there's different ways to measure it, but generally speaking, if you're looking at inventory, you're just trying to understand how many houses or properties are on the market at any given time. And this is important because it measures both how many properties are put up for sale and also how quickly they're coming off the market. So it measures both the supply side, like who's putting stuff up on the market, and the demand side, who's taking it off the market. And generally speaking, when inventory is really low, that indicates it's a seller's market, right? There's not a lot of options for buyers. And so the way that buyers compete with one another is by offering more money or waiving contingencies, all the crazy stuff we saw over the last couple of years. And if you look at inventory, it was extremely, extremely low. When inventory is higher, that indicates it is a buyer's market. And that means that buyers have the power, and there's too many homes on the market for the number of buyers. And so that way that sellers then have to compete is to lower their prices or to offer concessions. And so, in a normal housing market, let's say pre-2020, there would be some metro areas that would have high inventory, some would have low inventory, and they would all behave differently. In 2020 to 2022, inventory dropped everywhere. And that's another reason we saw prices go up. Now we will get to this, but we are starting to see that start to regulate. But this is one of my favorite things to look at. There's two metrics you can look at here. One's just called days on market. That's a good way of measuring. It's not exactly inventory, but it measures sort of the same thing. How long are things staying on the market? Or just active inventory, which is the number of sales, on market listings that are active at any given time. I think these are super helpful to check out. And we can talk about this more later, but generally speaking, the thing I think about a lot right now is like, where are inventory levels, not relative to where they were during 2020, 2022, they're going to be up, but where are they relative to pre-pandemic levels? Because I think that's going to give you a very good indication of how stable housing prices are going to be in those markets in the next year or so.
Got it. So you're kind of looking at a big picture context, and we have a link to the report you have, and it has some really good graphs of showing like over a 20-year period or a 10-year period what those like lines look like, and hopefully we can even get up on the screen here. But if you look at like now compared to pre-pandemic, and you see those like bar graphs, if the inventory is much lower now than it was, it definitely was lower than like 2008 and 9 when it was just the market was flooded with housing. You can see how that flow of inventory kind of flows into a buyer's market, a seller's market, depending on how many houses are on the market. Like in 2008 and 9, which I was an investor in 2003 and 4, then I got into the down market, and it was amazing. I mean, you can anecdotally see it when you drive in a neighborhood. Every other house has a for sale sign.
Oh yeah,
that's a massive inventory market. The opposite of that was the last 2 years, when you had every time you put a house on the market, 7 people making offers, it's off the market quickly. So that's a very low days on market, which I love measuring that as well. That's one of my favorite things to get from my local real estate agents. I'll ask them, what's the local days on the market. You can now get it from Redfin and Zillow as well. But the last couple of years, in my market, it's been 7 days, 10 days, things like that. Whereas when I first started investing, 2003, 4, and 5. It got down low too, but it's 30 days was good back then, and 60 days was more of a 60 to 90 was more of a normal days on market. You put the house on the market, 30 to 60 days, you'd finally get it under contract. 30 days later, you close on it. Like that was pretty healthy, normal kind of thing. And to have it be under contract in 3 days and then close in another 2 weeks, like that's very unusual.
Yeah, it's crazy. I'd have people say like, oh, over the last 2 years, it's like, oh, I'm liking this house, but it's been sitting on the market for 2 weeks. Something has to be wrong with it. What? Like back in the day, it was, a normal, I think in most markets, like 30 to 60 days is pretty normal. Mm-hmm. And we're still not even close to that, to be honest. Like, even though the housing market is correcting, it is still pretty low. And we'll get to that, but some weird things are happening right now.
Yeah, for sure. So what we're doing here, though, is just these are tools. Like these are tools you can look at, and I love how you mentioned the seller's buyer's market. That's when you think about inventory, if you can just remember, these are indicators telling you whether you're moving into one of those or not. And we're in the kind of consensus of the report, which will just give people a sneak preview of, is that it's starting to balance the other way. There's more of a tilt towards being a buyer's market, but it's not. I guess the context I want to give everybody is like there's a lot more range to go. Like the days on market has a big normal kind of distribution you can get. So inventory, supply, inventory, those are both two good things to look at. Let's go to the other side of this equation, demand, and I'm thinking just in particularly, I want to help people understand like the long-term reasons why the real estate market and the values are where they are, because it's really easy to say, hey, it's a bubble. There's these prices are ridiculous. And if you don't understand what's underpinning it, yeah, that makes sense. But let's talk about demand, particularly demographics, and how that's kind of driven a lot of the price raising of prices over the last several years.
I think one thing people really underestimate when they look at economics and the housing market in particular is demographics. Demographics are incredibly, incredibly important. And we are reaching a point where millennials, who are now the biggest generation in the United States, are reaching what they call peak family formation years. Normally, when people, reach somewhere around 30 years old, that's when they, start a family, they want to get a house for themselves. And so now we have the biggest generation of people wanting to do that. And sometimes these people are sensitive to interest rates or what's going on in the market, but not a lot. You and I, Chad, and people listening to this are investors. 70% of home sales go to just people who want a home for themselves. And a lot of people, they're starting a family, they're going to buy a house. Maybe they'll buy something smaller if prices are really high, but they want a house because they're starting a family. And that has been going on and sort of been this undercurrent, even during all the crazy stuff that was COVID related. This wasn't COVID related. This is just demographics. But that has been going on over the last couple of years and probably will keep going on over the next few years as well. And I think it's super important for people to understand that this isn't driven by necessarily rational logic. Like, not everyone who buys a house is thinking like, this is the perfect time to buy. Most 70% of people are usually just saying like, this is the time to buy because it makes sense for me and my family, not because it's like the idealized investment at this point. Right. So yeah. I really think people, it's not that hard to understand. Just understand that a lot of people want homes right now.
Yeah, absolutely. Well said. And the other thing I'll emphasize is just the millennial generation is huge. Like this is the biggest generation ever, even bigger than the baby boomers. And they are in the prime time of their buying careers. That was something that struck me in your report. I'll read some of the numbers. The 25 to 29 year olds are the highest 5-year kind of section of the population. They're the biggest. And so they're right before that, prime buying time. And then 30 to 40-year-olds are the second biggest 5-year segment. And then 20 to 24-year-olds are the third. So you've got this like straddling of that prime buying time right now. And even, just my rough projections, for another 5 to 10 years, like that same group of people are still going to be wanting to get homes, wanting to buy it. So that's a pretty big tailwind when you have that reality that people want to own homes a certain percentage of the millennials are going to own homes. And there's a big group of them. And there's some other, we could talk about this all day long, but there's other factors there too, that not everybody's living in big households. They're individuals who are buying houses. They're two people instead of a big family, so it's could be, not only are you having more people, but sometimes fewer people are living in one house, which even spreads that demographics out even more.
Yeah, there's a metric that's super hard to measure, but it's worth looking into, called household formation. And that's exactly what you're saying. It's not necessarily about like starting, a conventional family necessarily. It's like, when do you strike out on your own? Even if two roommates, just two friends, decide, oh, we're each going to go out and live on our own, that is a new household formation, even if they're renting. And that increases demand for housing, generally speaking. And I think the data for household formation over the last few years is really confusing, because COVID just was so weird. Like, people probably moved in together, then they moved out. No one wanted to be near each other. It's all this weird stuff. But over the next few years, that will be a really interesting thing to measure, not just for the price of houses, but for rent demand as well. Household formation is super important as well.
Cool. And I'll add something else, and feel free to jump in on this too. When you go to the micro level and you're looking at your own market, I'm going to plug a book that I know you had this author on your show, on your podcast. John Burns wrote a book a few years ago called Big Shifts Ahead. And I did a book review of that, and I'll put a link to that in the show notes. But one of the big takeaways that I've used successfully as an investor is to look at the demographic trends and where people, this growing population nationally, where are they moving within the country? And those are some really cool stats. I'll just give you some homework to do as everybody's listening. Look up, for example, U-Haul movement patterns. Like if you look at U-Haul report or some of the other moving companies, they show you where people are moving to within the country. Or you can read books like this book that I'm referencing, Big Shifts Ahead. And you can see there's some really massive, interesting movements of people on the net level. So I'm in the southern United States, and there's a big movement of people to the southern United States, often because of affordability, jobs, things like that, the weather, other reasons. The same, and so you can see these patterns. And if you're an investor, you want to have that tailwind behind you when you're investing in a region. And so that's one of the most important factors to look at, not only when you're trying to judge what's the market doing right now, but also like, where do you want to invest? This is such a critical piece of the puzzle.
That's a great tip. I did not know John Burns wrote that book. I love John. I'm a big fan of John's, and I'm going to read that book now.
Check it out. Yeah, I hope he does an update, because it was one of the best books I've read as a real estate investor. One of the most underrated books as well, and has lots of good tips that it was not written necessarily for us as kind of smaller real estate investors, but I took away a ton of good stuff that you can use.
Awesome. Yeah, I'll check that out. He writes mostly for like commercial, like institutional investors, but I mean, as a small investor, we should try and learn from what they're doing as well.
Take advantage. Absolutely. Ride on the coattails, right?
Exactly.
All right, so I'm going to keep moving through these because I want to get to 2023 and kind of about this underpinning of this knowledge that I want everybody to get is really important. And so we've talked about supply, we've talked about inventory, we've talked about demand. So we've got this kind of big picture, of the buyers, supply and demand. But the next one that affects whether people can buy properties are mortgage rates. And this has been a big story the last few years. So can you talk a little bit more about mortgage rates, and let's just I'll let you add on to this afterwards, inflation and how these two things have kind of played together and how that's affected the market.
Sure. So yeah, I mean, we talk about demand, about who wants to buy a home, but in real estate, so much of it is who can afford to buy a home as well. And because real estate tends to be a leveraged asset, people use debt to buy their homes. It's a super interest rate sensitive industry. And, we saw that to the housing market's advantage during the peak of the pandemic, where interest rates were super low and people could afford everything. And now for the last year or so, since the Fed has been raising interest rates and mortgage rates have been rising, we've seen the opposite, where affordability in the market has just completely evaporated. In early 2020, housing was one of the most affordable it's ever been in the United States because of this, because it was really before appreciation went crazy, but mortgage rates were extremely low. Now we are actually at a point where affordability is at a 40-year low. I think it's been since like early 1980s. It was the last time housing was this unaffordable. And so this plays a big role in what's happening in the future. But over the course of the last 2 years, historically, we've never seen a period of mortgage rates this low. I all the data I've looked at, there's never anything close to a 2.7 fixed rate mortgage ever. And I don't personally think we'll ever get there again. I think this was maybe, but probably not in our lifetime. So I think that this was sort of one of these black swan events for the housing market where things went crazy and now people jumped in on it. A lot of savvy buyers, investors, and home buyers alike locked in 30-year fixed rates, around 3%. And I think they're going to hold on to those mortgages for dear life for the rest of their lives if they can, because it's incredibly cheap. It's remarkable.
Yeah, we investors know how valuable it is to have that fixed rate mortgage as the market appreciates, as rents appreciate. And I think even people who own their own homes are going to look at that and say, well, I could go rent a property over here at a much higher payment than what I'm paying on my mortgage payment, or I could buy another house at a much higher interest rate. That's that gap, that delta between what interest rates were and what they are now is such a huge factor. That's what's affected a lot of the market currently, right?
Absolutely. And if you haven't bought a home before or analyzed a deal before, I think it's easy to underestimate the impact of mortgage rates. Someone on Twitter who I follow, an economist, posted this thing that showed that, I think it was in Dallas. Basically, if you wanted to move laterally to the same price, the same size house from 2 years ago, you'd be paying something like $1,200 more per month in a mortgage for the same house. It's a remarkable difference. And that's why even though there were strong fundamentals for why housing prices went up when they did, now that mortgage rates have changed, the fundamentals of the housing market have also changed. And, there's just not the same level of affordability. And that's, in my opinion, if we talk about moving into 2023, that's, the driving factor of what's going to happen over the next few years.
Yeah. Well, let's talk about it. Let's go there, and we can bring in inflation to the conversation as well. But so we've got kind of this foundation of understanding why prices are where they are, and we can kind of go back and keep reading David's reports as you go forward so you can understand these variables. But let's talk about what's happened since that time period we were just talking about. So the end of 2022 into 2023, what's changed, particularly with mortgage rates, and how's that affected the housing market?
Yeah, sorry, I forgot to talk about inflation. So basically, starting about a year ago, at the end of 2021, the Fed admitted that inflation was not transitory and that there was a serious problem, and announced that they were going to start raising interest rates in an effort to fight inflation. And the interesting thing is that, the Fed raising interest rates can help fight inflation, but there was a lot of things pushing up inflation. There was increased money supply, which is something that the Fed can try and address with mortgage rates. There were supply shocks. There's all sorts of stuff going on. So they decided to go really aggressive after the part of inflation that they can control, which is how much money is circulating in the system. And so they raised their federal funds rate, and that sends all of these shockwaves through the economy, basically where mortgage rates go up, the cost of lending everywhere goes up. And the idea is that will get people to stop spending as much, that will reduce demand in the marketplace, that will bring down inflation. That's what started to happen starting in March. Basically, as soon as that happened, mortgage rates shot up. Even though the Fed doesn't directly control mortgage rates, they have an impact on mortgage rates. And ever since then, we've sort of seen this cooling of the housing market. Since June of 2022, things have really started to turn. And I want to be clear that I think we are in a correction, but the severity of that correction, I don't think it's as bad as people really think it is. Prices have gone down, according to the Case-Shiller Index, about 2.5% to 3% in inflation-adjusted, seasonally adjusted terms, which is the right way to look at it. But mortgage rates are high, and we haven't really, seen what the impact of sustained high mortgage rates are. We've seen what happens when they go up for 6 months, and that might be one thing, but if they stay high for a year or 2 years or 3 years, that can mean something very different for the housing market. And that's something we still haven't yet seen.
So I'm just going to summarize this in my own kind of terms too. So the interest rate, the real estate market in particular, the whole economy as well, but particularly real estate is very sensitive to interest rates, to mortgage rates. People have to be able to afford a property and the interest rates affect their affordability. So now the interest rates are higher, it's much less affordable. So a lot of people are either out of the market, just can't afford to pay for it, or they're just choosing to say, all right, I'm just going to wait and see how this goes. That's affected the demand side of this whole equation we're talking about. So there's fewer people who either can or want to go out and buy properties, and that's affecting the pace of the market, how many people are buying it. But the numbers, so let's talk about those again, because I think there's a lot of sensational stuff out there, and I want people to kind of get kind of just some basic facts here, is that the before we had this tear, historically, significant rise in prices, 20% per year in some cases, compared to 3 or 4% normally. Lately, though, it looks like on the national level, it's been the overall market might have gone down how much? By about a couple percent?
2.5 or 3%, yeah.
2.5 or 3%. So yes, this thing has changed. You look at what it did 2 years ago to what it does now. That's the breaks. This thing has really changed a lot. But I think one of the concerns everybody has on their mind as an investor, what I get all the time in the comments is like, yeah, all this real estate stuff that works, but right now I would never want to buy a property right now because it's definitely going to crash another 20, 30%. And so I guess I want to kind of dig into that concept. Like we as investors, we have to look into the future. We have to make these decisions in an uncertain future. Like you're an investor as well. So like, how do you look at these uncertain times when there's people afraid that, man, this thing has changed a lot. It's gone from on a tear to slowing down. Like, how do you look at this and use all this data that we're looking at to make a decision on whether you should buy in 2023 or whether you should just sit on the sidelines and wait for some sign?
Yeah, that is the question, right? This is what everyone wants to know. I'll say this. I don't think the housing market is going to crash. And by crash, I mean like 15, 20% declines. But I do think the housing market will decline this year. I've said somewhere around 3 to 8% is my prediction for declines for 2023. I don't know. That's my best guess. No one knows for sure. But the reason I don't think it's going to crash is because the main thing that causes the bottom to fall out of a market is known as like forced selling. It's like when a homeowner has to sell because they can't make their payments. And that's just not happening right now. People might want to sell, people might not want to pay as much as they used to. But the whole phenomenon that happened in 2008, where there were these foreclosures and short sales and REOs, that is not happening. At least yet, it could happen in the future, but it is not. And I think that is one major reason I don't see the bottom falling out. The second is inventory, which we talked about. It's flattening out. It actually went down the last 2 weeks. So people were expecting, the people who say there's going to be a crash, these people aren't like bad people. The people who are forecasting a crash are basing that off of an increase in inventory, and that's not happening. And so I think there's a lot of reasons to believe that we are in a correction. Things are going to moderate, but they are not going to bottom out like they did in 2008. And personally, I honestly think it's probably a good thing. I do think the housing market was too hot. It's too unaffordable. Things need to go back down. But I just don't see it being this sort of like catastrophic crash in residential real estate. Now, I do invest in commercial real estate. That's probably a whole other podcast topic. I think that market could fall 15, 20, 30%. But that's for whole other reasons. How I invest is, I mostly invest passively. I live in Europe, so I mostly invest passively these days. But I would still buy right now, even if I lived in the United States, because one, we are in a buyer's market, and that means that you typically have more leverage in your negotiations. It's easier to find people who are willing to negotiate with you, and I am interested in buying for the long term. So I think, someone said something to me about the stock market that I think is true in real estate. It's like, if you need this money in the next 5 years, don't put your money in the stock market. I would say the same thing about real estate right now. If you need your money out in a year or in 2 years, I wouldn't do it right now. But if you want to invest for the long term, which you should, if you're a real estate investor, that's what real estate is good for. then I think you're fine. As long as I won't buy just anything, but if you could buy something that is, 5% under market value, I think you'll be doing pretty well. I've told this story a lot recently. I started investing in 2010, and the market nationally, and where I invest in Colorado, bottomed in late 2011. Was it a little scary to see the market go down 1 or 2% back then? Yes. Have I thought about it in the last 10 years? Absolutely not. People are always like, you got to buy in 2010. I was like, yeah, but everyone was scared back then, and so not that it's the same market, but I do think the mentality of just avoiding a market because there's uncertainty is not necessarily the right mentality. I think it's more about like, how can I buy under market value to ensure that I don't have a huge risk of equity loss and buy something that I know is going to be very valuable 5 or 10 years from now.
Yeah, I think that's right on. And I'll just kind of piggyback on some of that. To me, the long-term comment you made is the most important. Dave is one of the smartest people I know in terms of studying stats. And even you'll admit, right, Dave, that predicting the next 12 months, the next 2 years is super, super difficult, and nobody has a crystal ball to be able to do it, right? So the reality is, even someone with all the stats like Dave has, even someone who's been investing like I have for 20 years, I really don't know. Like, I don't know. I could see a scenario where things get really bad. It's like, there's always some probability, right, where things go down a whole lot, and I'm preparing just in case, right? But you have probabilities in my own investing, for example. I'm putting money out there. I'm investing with some other people. I'm more of a passive partner these days as well, but I'm putting significant money into deals right now that pencil, that make sense, and the fundamentals make sense. And so I think it always does go back to the fundamentals. You do need to pay attention to the market. You need to pay attention to the trends as much for opportunities as for risks. I mean, you want both of those, but I'm definitely not one of those running for the hills saying that you should stick your head in the sand and wait it out. Like, waiting it out is a fool's game. It doesn't work. I'm more I always like dollar cost averaging. The idea that one of my mentors in real estate was John Schaub. He wrote a book called Building Wealth One House at a Time. And his idea is just for the small investor, buy a house every single year. And if you do that, if you make that goal, then in the good years, the good buying years, when it's a really good market to buy in, you'll buy 2 or 3 properties because it's such a good buying opportunity. In the markets that are really, really hot and competitive, maybe you won't buy one that year. Maybe that's the case. So whatever volume you're in, you can look at it the same way. Like, the last 2 years have been a really difficult time to buy rental properties because the inventory was so low. Right now, it's more difficult to buy properties because the interest rates are high, but this is a great time to go out and make lower offers. This is a great time to get creative financing, which is something I talk a lot about, getting seller financing. And there's tons of new opportunities because the market's changed. But the fundamentals, which I'm going to go back to this housing 101 that Dave put us through today, the fundamentals of supply, the fundamentals of inventory, the fundamentals of is your market in demand, and how do those fit together? Like, that's what's important. Like, that's going to drive your investment returns over the long run, and particularly on the local level. How those work on the local level are really important. And so maybe you could piggyback on that just as we get kind of close to the end here, Dave. Like, local versus national, because we're talking a lot about national statistics. Could you kind of tell a little bit how that's looking in 2023? Because there's some interesting things where different markets are doing very, very different things.
Yeah, absolutely. I'll just say one other thing is that I also am investing right now. I think I looked at more deals in the last week than I have in like the last 6 months or so, just because the people who sponsor deals who I invest with are finding good deals right now, so it's getting more interesting. And I would just say that to just underwrite really conservatively, like, I'm assuming very little to no rent growth or appreciation for a few years. And if they still pencil, like, great, that's better than sitting on your butt for sure. But I will say that, in terms of local and national, prior to the pandemic, different markets behave very differently. And I did this one study right before the pandemic, actually, that was really interesting, that showed that, like, some markets have appreciation, some markets offer cash flow, and there's just a few of them that sort of offer a little bit of both. But it's almost impossible to find a market that has great cash flow and great appreciation. During the pandemic, that all changed, and everything appreciated like crazy. Rent growth went crazy everywhere. But I expect we will get back to that pattern where some markets are known for cash flow, some are known for appreciation, and some are what I call like sort of hybrid cities where they're sort of middle of the road for both. And I think depending on your strategy, any of those are fine. It just depends like who you are and what you're looking for. But I would just be careful to not use data from the last 2 years about appreciation. Like I met with a real estate agent to buy in an area in Texas I was thinking about buying in, and I went in person and saying, this place, it's, appreciation is average 15% over the last couple of years. And I was like, well, do you think that's going to continue? It's like, yeah, it happened for the last 2 years. So I was like, are you crazy? Like, of course it's not going to do that. Like, I think it's like really easy to get like swept up in sort of this like recency bias of what happened in some of these markets. I would almost, from a data perspective, unless you're like trained to know how to adjust for these things, just throw it out. Look at what happened in like 2017 to 2019. And that's probably similar to what's going to happen in these markets in the future. And some markets have fundamentally changed, like Austin, like that has just changed a lot. But I think if I were you and looking into a local market, I would be very deliberate about what your strategy is, what you want to accomplish, what kind of income you're looking for, and then picking a market based on its historical performance through the 2010s and not over the last few years.
Yeah, and just to get specific with what I think you're saying there, like if when we run our numbers, if you could boil down running the numbers, which you wrote the book on running numbers, so you can check that out again. But I always like to simplify it into you make money in real estate on income or you make money on growth. Those are your two way, and the property can grow, the rent can grow, the property can produce income, and you can use that income to put in your pocket. You can use it to pay the loan down. And so those are the two fundamentals. And some markets, like you say, have really high percentage of cash flow compared to what you pay for it. Other ones have tiny ones. Like if you buy in San Francisco on the peninsula, like even if you paid cash for it, you'd be lucky to get like a 3% or 2% cash flow, right? That's very, very low. Whereas if you buy in states that I'm familiar with, South Carolina, in a good location, Greenville, South Carolina, kind of the metro part of Greenville, South Carolina, I wouldn't buy a small multi-unit property if you couldn't get a 6 or 7% cash return, paying cash for the property, right? So big difference there. If you buy in South Carolina in that market, you might expect over the long run, based on the last 50, 60 years, 3% appreciation. Some areas 2.5%, 3.5%. That's kind of been the average. So, but if you put those fundamentals together, 6 or 7% cash flow and 2 or 3% growth, that comes out to like 9, 10%, somewhere in there. Hey, there you go. That's how it can get more complicated, but that's kind of how you run the numbers. And if you look at an appreciation market, you look at a market that makes a 3% cash return, it better make 5-6% appreciation in order to match this other market that we're talking about that might have 7% or 6% plus 2 or 3% growth. So those are really kind of simplistic ways to look at it, but I don't know. That's how I think about it when you're looking at the numbers, and when you choose a market. I love how you just tell people you got to choose. Do you want a cash flow market? Do you want a growth market? Do you want a hybrid market? And there are hybrid markets out there that have these good supply and demand demographics that also still have rent to price ratios that are pretty reasonable. Like those are I love those markets. I love those. Another John Burns term, suburban markets, like suburban markets that have urban qualities, small towns. If you buy in Manhattan, you're not going to get that good hybrid. You're going to have to pay a pretty high price. Whereas you get, easily South Carolina outside of Greenville, or Noonan, Georgia, or other no-name towns that nobody knows about unless you live in the area. There's tons of opportunities in those little suburban, urban little pockets with 30,000 people in the town, good, solid, jobs all over the country. There's so many opportunities out there.
I totally agree. Yeah, I absolutely agree. I think, partially this is my fault because I published these lists about best markets and stuff, but I think people over obsess about finding the best market. There are great opportunities, like you said, all over the place. I think for people like you and I who invest passively, it's kind of important to pick great up and coming markets. But if you're an investor who's going to run the property yourself, or you live locally, being close and having a great team is equally, if not more important than picking like the best market. Like you said, there's just so many good opportunities out there. I would focus more on in your own backyard, unless you're sort of a more experienced investor or you live in, Manhattan or San Francisco. I think there's just a lot of opportunity that people ignore because they're not these sexy markets. But sometimes, if Henry Washington, who's on the Market podcast with me, he talks about it all the time. Like the unsexy markets are the one that offer the biggest returns a lot of the time. So I think there's a lot of truth to that.
Absolutely. Well, tell Henry hello from me. Henry's a friend.
I will. I love Henry. He's a great guy.
And Henry's in another similar area to Little Rock, Northwest Arkansas, South Carolina. We're in those good, unsexy southern markets, but good places to be. Dave, this has been awesome. So much more we could talk about, and maybe we could do some market analysis because your list of top markets are very helpful. So I think people should check those out. I'll actually put another link to that as well. So lots of good data out there, good things to check out. The question I want to close with this, we've talked about the fundamentals of analyzing the market. We've looked at the last 2 or 3 years to try to understand what's going on there. We've gotten a couple, just our opinion on where things are in 2023. What are if you had to leave everybody with some homework, what are the top things you'll be looking at as 2003 continues? Like what are the trends or kind of the stats that matter that you'll be paying attention to and that maybe everyone else can kind of pay attention to as well?
All right, I got one that's very boring and nerdy, but pay attention to the yield on 10-year US Treasuries. I know this sounds so boring. You don't even need to understand it. All you need to do is understand that mortgage rates and the yield on 10-year US Treasuries are almost perfectly correlated. When 10-year Treasuries go up, mortgage rates go up. When they go down, they go down. The Fed does not control mortgage rates. Bond yields control mortgage rates. And to me, we've talked a lot about affordability in the housing market. The direction of the housing market, whether it crashes, whether it grows, all this really is going to come down a lot to mortgage rates. And so there's a few ways that mortgage rates could go down this year. The Fed could cut rates. If we go into a recession, that usually pushes bond yields down, and that would push mortgage rates down as well. If inflation goes back up, we'll probably see mortgage rates go even higher. And so to me, I think for the first 6 months of 2023, we're going to see the same kind of market we're in right now, where everyone's just kind of feeling around, trying to figure out what's going on. But if you want to understand what's going to happen second half of 2023 and into 2024, I would watch that. I look at it every day, but if I'm a nerd, you don't need to look at it that frequently, but that's something really important. And then I would keep an eye on inventory. I think it's super important, and it's going to start, diverging on a market by market basis. We're already starting to see, I put in a report, if you look in Austin, Texas, inventory is well above pre-pandemic levels, indicating prices are going to fall. If you look in some of these small towns or in Chicago or Boston or Philadelphia, it's still well below pre-pandemic levels. And so these are going to be another thing that's really going to tell you what might happen in an individual market over the next couple of years.
Awesome. 10-year Treasury yields for the win. I love it. I look at those as well, but I'm a numbers nerd too.
I just feel like people need to know, like, bond yields rule the world. It's so weird, but it's so true. It controls the stock market, mortgage rates, everything.
This is like the Matrix. Be careful if you want to take the green pill or the red pill. If you start looking at 10-year Treasury bonds, you will go down the crazy rabbit hole of analytics. So be careful.
You will.
Dave, this has been a lot of fun. Where can people check you out, follow along with you? I know you have a lot of presence online. You're putting a lot of great stuff out. Where do you recommend people check you out?
Well, thank you. Yeah, so you can always find me on BiggerPockets. I put out blogs, YouTube there every week, or on Instagram, where I'm at the Data Deli, where I put quick economic and real estate research tips out every day.
Awesome. I will put links to all that, and people can check you out. I highly recommend it. And I will hopefully see you soon, Dave, and at the BiggerPockets Con or some other place.
Oh, for sure.
But appreciate your time and look forward to talking again.
All right. Thanks a lot, Chad.
All right. Take care. I hope you enjoyed that interview with Dave Meyer. He's just a wealth of information. I know I got a lot out of it, both listening and talking to him and also reading his report. So I hope you'll check that out. There'll be a link again in the show notes if you want to read a lot of what we went over today. I also want to encourage you to check out next week's episode. I'm very excited about a new series called a Deal Deep Dive. And after getting feedback from a lot of you, you said you wanted to get the details of real deals from real investors out there in the market today doing deals. And you want to know the numbers behind it. How do they find the deal? What did the rent look like? What did they pay for it? How did they finance it? That's what the Deal Deep Dive series is all about. And I'm starting next week with the first one. Give me some feedback. Let me know if you like it once you watch the episode. Leave a comment on YouTube. Send me an email at podcast@coachcarson.com. I'd always love to hear from you and understand if this is helpful to you. If there's something you want more of, or if there's something different you want. Always love to hear from you. And I hope you enjoyed this episode, and I'll see you next week. If you like the show, I'd like to invite you to subscribe to my free email newsletter at coachcarson.com/REI Toolkit. In addition to weekly updates, articles, and behind-the-scenes tips from me, my email newsletter subscribers get my real estate investing toolkit, which includes a property closing checklist that I actually use when I buy properties, a real estate deal worksheet, a tenant screening criteria checklist, and other spreadsheets and goodies that will help you on your journey to financial independence using real estate. You can get it all for free at coachcarson.com/REI Toolkit. I also want to take this time to thank some people behind the scenes who make this podcast possible each and every week. This includes my podcast editor extraordinaire, Michael Wynn, my amazing virtual assistant, Megan Thompson, my wife, Carrie, who helps me behind the scenes and is my partner here at Coach Carson. And of course, thank you to all of you, the listeners of this show who make everything possible. This show exists for you. It exists because of you. And I really appreciate you being here for another episode. Everything I've shared with you in this episode has been for general education purposes. I've not considered your specific situation or risks. Before buying your own investments, be sure to consult a financial, real estate, and/or a legal professional. Until next time, I'm Chad Carson. You can also call me Coach, and this is a show all about helping you get out of the financial grind so you can do more of what matters. See you next time.